Good morning and welcome to my office. Let's get started.
Shanghai just broke the silver market, and the West is scrambling to contain the fallout. The Shanghai Gold Exchange launched a new physical silver contract requiring 100% physical delivery, no cash settlement, no paper games. Within 72 hours, the premium for physical silver in Shanghai hit $100 per ounce, while COMEX futures traded at $32. That's a $70 premium, 218% above Western. Paper prices. This isn't a trading anomaly. This is the moment physical and paper markets decouple permanently. Why is the West terrified? Because for 50 years, COMEX in New York and LBMA in London set global silver prices through paper contracts with minimal physical backing. Shanghai just proved those prices are fiction. If physical silver is worth $102 in the world's largest manufacturing economy, what are your COMEX futures really worth? In the next 5 minutes, I'll show you exactly what happened in Shanghai, why the $100 price is real, not manipulated, how COMEX is responding in panic, and what this means for every ounce of silver you own. Because the market just broke, and it's not coming back together. Let's establish the timeline. The Shanghai Gold Exchange, SGE, China's state-backed precious metals exchange, launched a new silver contract, the SGE Physical Silver 100 million dollars contract. Unlike COMEX futures, this contract mandates physical delivery, no cash settlement option. If you buy the contract, you must take delivery of physical 100-gram silver bars stored in SGE-approved vaults in China. Within 48 hours, trading volumes surged. Chinese industrial users, retail investors, and institutions rushed to secure physical silver. Why? Because China is the world's largest silver consumer, 620 million ounces annually, 51% of global industrial demand. Solar panel manufacturers, electronics companies, EV battery makers, they all need silver, and they don't trust COMEX paper. By hour 72, the SGE physical silver premium exploded. While COMEX silver traded at 32 Oz in New York, the SGE contract traded at 720 yuan per 100 grams, equivalent to 102 Oz USD. Arbitrage should have closed this gap immediately. Buy COMEX at $30, deliver to Shanghai, sell at $102, pocket $70 profit. But it didn't, because there's not enough physical silver available to ship. This is the critical insight. The premium exists because COMEX can't deliver physical metal to meet Shanghai's demand. The 400 million ounces of paper claims on COMEX are backed by only 98 million ounces of registered physical silver. When Shanghai demands real metal, the West can't provide it. The market broke. Is $102 the real price of silver, or is Shanghai manipulating the market? Let's break it down. Factor number 1, physical scarcity in Asia. China, India, and Southeast Asia consume 73% of global silver for industrial use. They need physical metal delivered to factories. Paper contracts are useless. When Shanghai, buyers bid $102 for physical delivery. They're revealing what silver is worth to someone who actually needs the metal, not a speculator trading paper. Factor number 2, COMEX registered inventory depletion. Registered COMEX silver has dropped from 136 Oz, Jan 2023, to 98 Oz, Feb 2025, a 28% decline in 24 months. Available deliverable silver is scarce. When Shanghai demands delivery, there's a scramble. Those who can deliver physical command premium prices. Factor number 3, currency and capital controls. Moving silver from west to east requires export licenses, shipping logistics, insurance, and navigating China's capital controls. These costs add $8.15 Oz, but a $70 premium can't be explained by logistics alone. The premium reflects supply-demand imbalance. Factor number 4, no arbitrage closing the gap. If the gap were artificial, arbitrageurs would close it in hours, buy COMEX, ship to Shanghai, profit. But the gap persists because A, COMEX doesn't have enough physical to deliver at scale. B, China restricts silver imports to control supply. C, Western holders won't sell at $30 when they see Shanghai paying $102. Conclusion, $102 represents the true physical scarcity price in the world's largest industrial silver market. $30 COMEX represents the paper fiction price, where 400 Oz of claims trade on 98 Oz of metal. The question isn't, is Shanghai right? It's, how long can COMEX maintain the fiction? How is COMEX responding to Shanghai breaking the market? Panic and suppression. Response number 1, margin requirement increases. Within days of Shanghai's $102 price, COMEX raised margin requirements on silver futures by 18%, from $8,800 to $2,400 per contract. This forces leverage traders to deposit more capital or liquidate positions. The goal? suppress buying pressure and prevent COMEX prices from rallying toward Shanghai levels. It's the Hunt brothers playbook. When price threatens to spike, change the rules. Response number 2, coordinated short selling. In the 48 hours after Shanghai hit $102, COMEX saw massive short positions added, an estimated 35,000 contracts, 175 million Oz of new shorts. This selling pressure capped COMEX prices at $32, $34 despite Shanghai's surge. Who's selling? The usual suspects, JP Morgan, HSBC, Scotiabank. They're defending the paper price to prevent panic. Response number 3, media blackout. Check Bloomberg, Reuters, CNBC. How much coverage of Shanghai's $102 silver? Almost none. Western financial media is suppressing the story because acknowledging it would trigger a run on COMEX. If investors realize physical silver is trading 218% above paper, they'll demand delivery en masse. COMEX would collapse within weeks. Response number 4, diplomatic pressure on China. Behind the scenes, U.S. Treasury and Federal Reserve officials are pressuring China to stabilize the SGE silver market, code for stop revealing the real price. China's austere response, silence. They're allowing the market to function because it advantages their industrial base, access to physical silver, and undermines dollar-denominated commodity pricing. The panic reveals the truth. COMEX knows it can't compete with a physical delivery-only market. Paper games only work when everyone pretends the paper equals physical. Shanghai stopped pretending. Why does Shanghai's $102 silver terrify the West? Because it's not about silver, it's about control of commodity pricing and dollar hegemony. Threat number 1, pricing power shifts east. For 70 years, commodity prices have been set in New York, COMEX, and London, LBMA, in US dollars. Oil, gold, silver, copper, all priced by Western exchanges. This gives the US enormous power. Control the price, control the market. If Shanghai sets the real silver price, it breaks Western pricing monopoly. Other commodities could follow, copper, lithium, rare earths. The East sets prices, the West becomes price taker. Threat number 2, dollar loses commodity backing. Commodities traded in dollars create artificial demand for dollars globally. Every country needs dollars to buy oil, silver, copper. This supports the dollar's reserve status. If China prices silver in yuan and demands physical delivery, it bypasses the dollar. The petro yuan for oil, now the silver yuan for silver. Dollar demand weakens. Reserve status erodes. Threat number 3 reveals paper market fraud. The $70 premium proves COMEX is a fractionally reserved Ponzi scheme. 400 million Oz of paper claims on 98 million Oz of physical is fraud. If this becomes widely known, trust in all Western financial markets collapses. Not just silver, gold, oil, bonds, stocks. If silver futures are fake, what else is fake? Confidence crisis. Threat number 4, industrial supply chain shifts. If Shanghai controls physical silver at $102, Chinese manufacturers have guaranteed supply while Western competitors scramble to pay premiums. China's solar, EV, and electronics industries gain competitive advantage. Western industrial base weakens further. This is economic warfare through commodity control. The West is terrified because Shanghai's move is a template. Apply it to copper, lithium, rare earths, commodities where China dominates consumption and production. The entire Western commodity pricing infrastructure collapses. Dollar hegemony falls. This is why the panic. Shanghai proved physical and paper silver are different assets. What does this mean for you? Implication number 1. Your COMEX futures are worth $30. Physical is worth $102. If you hold SLV, the largest silver ETF, you own a claim on unallocated silver held by custodian banks. You don't own physical. You own paper that tracks COMEX prices. When divergence happens, you get $30. Someone with physical coins gets $102. The difference, ownership. Implication number 2, premiums on physical will spike globally. U.S. coin dealers already charge 4-6 premiums over spot. As Shanghai's example spreads, expect premiums to hit $10, $20 over COMEX. A $30 COMEX price becomes $42 or $50 all in for physical eagles or maples. Buy now before premiums explode. Implication number 3, COMEX may force cash settlement. If delivery demands surge, COMEX could invoke force majeure and settle contracts in cash at 32 Oz. You bought futures expecting delivery at market price. You get paid $32 while physical trades at $102. Legal? Debatable? Likely? Very, if COMEX faces insolvency. What I'm about to show you next, the 3 scenarios for how this plays out. COMEX collapse, dual pricing, or Western capitulation, the timeline to resolution, and the exact strategy to position yourself. Because Shanghai broke the market. And the only question is whether you own the real asset or the paper fiction. How does the Shanghai COMEX divergence resolve? 3 possible outcomes. Scenario 1. COMEX collapse, 30% probability. Physical delivery demands overwhelm COMEX registered inventory. Exchange declares force majeure. Cash settles all contracts at 32.0Z. Lawsuits follow. Confidence in. COMEX destroyed. Physical silver decouples permanently. Shanghai prices prevail globally, 8120 Oz. COMEX becomes irrelevant. Western investors holding paper, SLV futures, get destroyed. Physical holders win massively. Timeline, 6 TARD or 18 months if delivery demands continue. Scenario 2, dual pricing. Regime, 50% probability. COMEX and Shanghai prices diverge permanently. COMEX becomes a paper-only market, trading 30 at 40 $SAs for speculators. Shanghai becomes the physical market, trading 80 $120 AUZ for industrial users and serious investors. Western retail buyers pay 30 to 50% premiums over COMEX to get physical. Dealers arbitrage the gap. This is the current trajectory. Market split by geography and asset type. Paper versus physical. Scenario 3. Western capitulation, 20% probability. COMEX raises prices to match Shanghai levels to prevent collapse. Silver rallies $32, $80, $100 over 12 to 24 months. This saves face for Western exchanges, but admits defeat. They're no longer price setters, just price followers. U.S. government may intervene, ban silver exports, price controls, to prevent wealth transfer to East. Most likely outcome. Scenario 2. Dual pricing persists for years as East and West financial systems decouple. Physical holders win in all 3 scenarios. Paper holders lose in scenarios 1 and 2, only win in unlikely scenario 3. When does this resolve? When one side capitulates or the market breaks completely? Phase 1, current 3 months. Denial and suppression. COMEX raises margins, adds shorts, media blackout. Shanghai premium persists, but doesn't widen dramatically. Western investors largely unaware. Physical premiums in U.S. rise to 8.12 over spot. Phase 2, 3-9 months. Acknowledgement. More investors learn about Shanghai's $102 price. Delivery demands on COMEX increase. Registered inventory drops toward 60 $. Premiums spike to $15-25 in U.S. Mainstream media forced to cover the story. SLV sees redemptions as holders realize unallocated risk. Phase 3, 9-18 months. Crisis or capitulation. COMEX either collapses. Scenario 1 accepts dual pricing. Scenario 2, or rallies to match Shanghai. Scenario 3. Resolution forced by COMEX registered inventory 50 GEMAS or Oz, or major delivery failure or U.S.-China diplomatic agreement on silver pricing. Best case for physical holders, crisis in phase 3, prices converge upward to $80, $120. Worst case, dual pricing. Persists indefinitely, but physical still worth 2 to 3x COMEX paper. Shanghai hit $102, COMEX at $32. The market broke. What do? Action number 1, exit paper silver immediately. If you hold SLV, silver futures, or any unallocated silver, sell now. These track COMEX's $32 fiction. Switch to physical or PSLV, Sprott Physical Silver Trust, 100% allocated and audited. The risk of cash settlement or permanent divergence is too high. Action number 2, buy physical aggressively at current premiums. Premiums are 4 TAs or 8 over COMEX now, $36.40 all in. When Shanghai's example spreads, premiums hit 15, 25, 47, 57 all in. Buy American Eagles, Canadian Maples, or 10 O's bars now. Accept current premiums. They're cheap compared to what's coming. Action number 3, take personal possession. Don't use bank vaults or unallocated storage. Home safe, private vault, or allocated storage with audit rights. PSLV, bullion vault. If you don't hold it, you don't own it. Shanghai. Prove this. Action number 4, ignore COMEX price volatility. COMEX will manipulate prices down to $28 to $30 to shake out weak hands. Ignore it. You're buying physical at Shanghai's reality, 102, not COMEX's fiction. Short-term paper price is irrelevant. Action number 5, monitor COMEX inventory weekly. Track registered silver at cmegroup.com. If it drops below 60 MAs, we're in phase 2, crisis imminent. Below 40 MAs, cars phase 3, collapse or capitulation. Shanghai broke the market. $107 physical versus $30 paper. The divergence is real. The West is terrified because it reveals 50 years of price suppression. You now understand what's happening. Full Shanghai Gold Exchange data, COMEX inventory, and historical divergence precedents linked below. Educational content, not financial advice. But the market broke, and physical silver is the only real asset.